Good morning, everyone. Welcome to this update for global stocks and commodities for the 6th of October. It was another week of somewhat extreme ups and downs, and I think we've just got to get used to it. This is the way it's going to be for the foreseeable future with all asset markets as stretched as they are. I think this sort of volatility, this sort of backwards and forwards kind of movement is going to continue in not only in stocks but in other asset classes as well. This week, I just want to talk about the sentiment of going a bit too defensive, which I'm starting to get a sense of from questions and comments that I get from various places. That a lot of people are very concerned about what's going on with the trade dispute and Brexit and everything else that's happening, and some people are sort of, I think, overreacting to a bit of a sense of negativity that's out there in the market. So I want to try and put that in perspective this week. Okay, let's jump into it. This is, to my way of thinking, there are always terrific opportunities, and this is a wonderful time if you have a thought process of being a bit contrarian or being alert to contrarian opportunities. Now, being a contrarian doesn't mean that you just take the opposite view of everybody else and you'll make money, because that clearly isn't the case. You've actually got to wait until you get to an extreme, and then it starts to turn the other way. So you've got to wait for the turn. But it all starts with the preparedness to be open-minded and to be contrarian and not to think the way that the rest of the crowd thinks. And with so much volatility and so much seemingly irrational behavior, this is a great time for contrarian thinkers. And there is a process that you can use. It's really a state of thinking that you can use, which is, I think, going to stand you in very good stead. So we'll take a look at that shortly. We'll have a look at the normal stock and commodity trend update. And last week in Portfolio Analyst, amongst many other questions, I really addressed the issue of putting fundamental analysis and how you go about it into a perspective. Let's look at American stocks first of all. The S&P fell just 9 points in the end, with a very strong recovery at the end of the week. So it's down just 0.3 across the whole week. And on Friday, and leading up to that, we'd had a succession of negative economic data. We'd seen manufacturing data was weak, and then we saw jobs data was weak, and then we saw some more numbers on Friday. But in a sense, they were sort of perfect in a way, because the jobs number was good enough to not suggest that American economy is heading for a recession, but it was bad enough to suggest that we're likely to get more rate cuts from the Fed. So the market absolutely loved that, the fact that it's not going into recession, but more rate cuts, just the perfect outcome. And the market rallied significantly. And I think that'll probably sustain the market until the next event comes along. This week, the US trade discussions will obviously be the big focus. And I don't know about you, I'm getting tired of it. Honestly, it's just a political game that's being played on both sides, and it's really ideological, and it's going to continue for a very long period of time. The US dollar was down slightly because of the likelihood of the Fed cuts, and the other data being poor, but not poor enough. And the 10-year yield dropped again, down to 1.53. So let's take a look at some charts. And we'll start with the S&P. So you can see that the 200-day moving average, the red line, has just turned up a little bit. So it had been flat for the last quarter of last year and for most of this year. And with the price remaining above the 200-day, it's now started to turn up a little bit. The 50-day is still above it, and the price has just been fluctuating, pivoting above and below that 50-day moving average. So the only way to interpret that is strength. When the price is above the 50, which is above the 200, then that's about as good as definition you're going to get of relative strength in the market. Now, we are in a consolidation phase and we are at all-time highs, so we may not get a breakout anytime soon. But if you had to toss a coin and say, is the market likely to break out above 3,000 points, or is it more likely to break down below 2,800 points, then I know the one that you have to choose. It's pretty obvious. So don't overthink this. Don't try and second guess that the market might be going to go down for various reasons. And I think a lot of people are just getting sucked into the media discussion at the moment about how much negativity there is out there. But I'll have more to say about that shortly. This is the US dollar. So we had quite a strong move early in the week, but then basically gave it all back. Well, not gave it all back, but gave part of it back by the finish. And just while I'm here, let's look at the Australian dollar. So we obviously continue to be in a downtrend. The red 200-day moving average line is clearly still going down and the price is quite comfortably below it. So whilst it's bouncing up and down, we are still very clearly in a downtrend in the Australian market. And I think the overwhelming odds are that the RBA cuts rates again down to 0.5 and possibly even lower. And I think it's also quite likely that we're going to see some sort of quantitative easing, some sort of bond buying or something of that nature in Australia in the not too distant future. We've never had it before, but I think it's starting to look somewhat inevitable now. All right, moving on to Aussie stocks, 67.69 was pretty much unchanged on the week, but our market had an ugly week, fell nearly 200 points, 3%, but will obviously rebound quite strongly given the weakness of last week and then the strong recovery in the US. So we'll see quite a good recovery in the Australian market, I would imagine, on Monday. If we don't, then that is a pretty bad sign. So it's managing to hold above the 200-day moving average. Let's just go to the ASX 200. So you can see the 200-day moving average is moving up. It's been moving up more strongly than the American market. So we had been outperforming, but you can see Thursday and Friday were two pretty ugly days in Australia. So we're just holding that 200-day moving average at the moment. Now, turning to precious metals, and I think this is a bit of a case study in the opportunities in contrarian thinking. Now, gold rose a little bit in the end. It was all over the shop last week, and it rose a little bit to 1505. And I'm firmly of the belief that we're still in the early stages of a major long-term advance. But one of the realities is, and there are many things that drive the gold price, but one of the realities of what does determine the gold price in the shorter term is what's happening in the futures market. And there is the amount of speculation in the gold futures market became quite extreme leading into early September, and that overhang to a degree still exists. And while that overhang exists, the gold price is not going up very far because, to a degree, the gold speculators have pretty much put all their chips in the middle of the table. And there's probably not a lot of buying left unless there was some very disruptive macro event. So I think that positioning in the futures market still needs to unwind a bit. That's going to keep some pressure on gold, and therefore I think more consolidation is still warranted in the gold market. But look, I just want to make the point that the best time to buy, whether it's gold or whether it's stocks or anything else, the best time to buy is when it feels absolutely miserable to do so. And I think that's really the point that I want to make today for people that are starting to get too defensive about how they think. Because when you start thinking defensively, what you do is you stop thinking about opportunities. And there's always opportunities. They're absolutely everywhere because every asset class goes through cycles of being overbought, oversold, being bullish, being bearish, whatever it may be. And if you shut yourself off to those opportunities that are just building all the time by taking a very defensive mindset, then you're much worse off for it. It's okay to go somewhat defensive, but you need to ensure that it's the right time for that asset. And I know that a lot of people are looking at the traditional sort of safe havens, infrastructure stocks, and that sort of thing. But look, right now, they're the crowd favourites in the defensives and have been for some time. And what that means is that the price has gone up quite a long way. They're now just simply outrageously expensive because people have been piling into them in the hunt for yield. And so that's pushed the yield down. So the price of the asset goes up, the yield goes down, and now the risk of capital loss is so much higher. And the yield, at the same time, the yield is less. So it's really a bad equation. So to me, that doesn't sound like a good place to be parking your money with a defensive mindset. So as I said, there's not really an issue with going defensive, but you've just got to keep it all in perspective. The answer to me is that you do your homework, you know what's highly likely to rise because of big picture drivers, which are independent of the macro picture, and then you buy them after a pullback. It's a very straightforward formula, but it's hard to do. And it's hard to do because it goes against how we're wired, firstly. And secondly, sometimes we just have to wait many, many months, sometimes longer, for something to become, to pull back enough to become a really good contrarian opportunity. And for most people, that's almost impossible to do if you don't have real clarity about what you're doing. And I know from doing this, what I do for nearly 2 decades, I know that most people resist the process of getting clarity about what they're doing. So this is just where the analysis of sentiment and technicals is so absolutely vital. So I want to make one more point, but I'll make it at the end. So just to finish on gold, we're still in a consolidation process that I think still has maybe 3 to 4, maybe 6 weeks yet to play out. And if we look at GDX, it's tracing out the same sort of wave 4 consolidation pattern that we're seeing in gold. So all that lines up pretty well. And if you think about what really drives, particularly in the speculative futures gold market, there's a natural cycle of speculation. It starts with the price starting to move up, and that sort of builds hope, and more people pile into the trade. And then you get to a level of confidence and euphoria, and then all the money's in, and you end up with an exhaustion. And we saw that with GDX and with gold at the start of September. There is a wonderful time brewing, a buying opportunity for gold and gold stocks, but we're not there yet. So there's still a little bit of time yet to play out. So let's take a look at the gold price. So we'll start with the daily first of all. So you can see we did go up a little bit on the week. On a daily, the 50-day is still way above the 200, and obviously the price is above the 50-day. Now, you could look at that and say that that's a sign of strength, and it is, but I just worry a little bit about this overhang in the futures market, and I've just seen this play out so many times over the years in the past. Until that futures overhang gets unwound, I don't believe gold is going to break out and go higher. There's every chance that gold could come back into the 1450 kind of area first. Let's look at it on a weekly, so you can see a little more clearly on the weekly the run that we had. So things really got started in October last year. We then had a really strong leg up. We got a consolidation, sort of a wave 2 consolidation, which didn't go very deeply. That then took off at the end of May this year. We had an enormously strong third wave to the upside. We're now getting a consolidation. This consolidation tends to be longer and more volatile, more complex than this consolidation. So that's why I just think this has more time to play out yet. And if we go to GDX, the 200-day moving average is always a useful marker. I'm not saying that the price will get back to there, but looking at history, 25% corrections are a pretty nice sort of average. They vary anywhere from 15 to 40%. with 25 being a pretty useful sort of average. So 25% from this peak takes $7.50 off the peak, which gets you back to $25, almost exactly where the 200-day moving average. So probably no coincidence that that would be an excellent buying opportunity area, I believe. But look, the low might end up being higher, it might end up being lower. The point is, I think there's still some time to play out. There's a terrific opportunity for gold because I think the long term is definitely up, and that's supported by the fundamentals. So, stay tuned. Really good opportunity, I believe, brewing in the gold space. And look, the key point that I want to make is that corrections are nothing to fear. When you understand what they are, corrections are merely a rebalancing from excess greed. The market's just got ahead of itself, created by that strong upleg. So an upleg starts, people see it. First of all, they don't believe it. And then they start buying into it in a sort of ginger fashion. And then they get more and more confident. And then by the end, they're sort of really, really bullish. And so that's all that a correction is. It's just a rebalancing of that natural sort of process. We need to learn to take advantage of corrections, not fear them, and drop into this totally defensive mindset that I suspect a few people are sort of falling into at the moment. Other commodities, copper was down to 254, and really global growth concerns are really sort of taking their toll on commodities. Crude oil also declined further to $53. And there was a very interesting case that I read through the week that could be made. This is long term, so we're talking probably 3 to 5 years and beyond. There's actually a pretty rational case to be made for oil prices to get back below $10 as the use of electric vehicles really reaches that tipping point and really takes off. So watch this space on crude oil. There's the spot copper chart. You can see we've now broken the support at $2.60. We held ground there for a little while, but we've now broken down in copper. But nickel, interestingly, because of the bans from Indonesia, nickel continues to hold up extremely well. So I spoke before of the required process if you want to profit consistently. And you just need to learn to overcome your natural inclination, which has you selling when you get fearful and when the crowd gets fearful, and buying when the crowd is confident. If you consistently do that, you're going to get beaten up in the market. So you've got to learn to overcome that natural inclination. As I said at the start, I see people being a bit nervous and stepping back from the market. I really urge you not to do that because it just creates the wrong mindset. You put up the blinds and you stop looking for opportunities. And there are always opportunities, even in bear markets. There are wonderful opportunities. So this is a great time, I think, to be alert to those opportunities because they are everywhere. I think we're in a bit of a soft spot for gold stocks, just as one example. But there's a great opportunity brewing. So don't close your mind to that. Skilled contrarians win far more often than everybody else does. But it's not an easy place to be because you've got to fight the crowd. You've got to fight what your mind is telling you. You've got to fight what the media is telling you. So it's not an easy place to be, but it's certainly where the winners are. The process that I go through, and I talk a lot about this in Portfolio Analyst and also in the Insiders Club, understand what the highly probable drivers are that are going to apply independent of trade wars, independent of political things like Brexit, etc. And once you've understood that, then it's relatively straightforward to put together a list of outstanding stocks that are going to lead through those sort of periods. Then you wait for the pullbacks to enter, you take some profit when they become extended, and it's a relatively straightforward process. It's not that easy to do because it's not how we're wired. Portfolio Analyst this week, I'm going to be putting some real focus on this topic because I think it's really important, and I think this is a great time to be raising your awareness. So it's going to be the art of contrarian buying, as well as a recap on the progress of the 10-bagger portfolio, plus some other really high-performing stocks that have been identified in Portfolio Analyst. The 10-bagger portfolio is a 3 to 5 year project that I started in June. It's gone better than I would have possibly hoped, and I had some pretty bullish expectations, I got to tell you. But it's going along really nicely, so we'll be doing a recap on that as well. There's still a 2-week $1 trial available for anyone that's not tried Portfolio Analyst. I think you'll get a lot of benefit from it. So that's it for this week. There's my contact details for anyone who is not a member, and I'll be back with you next weekend. Cheers.